If you're not good at looking at technical analysis and reading charts, then at least be good at fundamental analysis. A stock is not the price. A stock is a company. You are investing in a company. So guys, please do your research. And this is the best easy way to do research on a stock that you're investing. Canadian stocks, BD investing. Today we're going to be doing something a little bit more practical, because you guys have been asking me to go over how I do a stock analysis. So today we're going to be doing a quick stock analysis on Google stock. That way you can just open up your Yahoo Finance app and do a quick analysis if you want to purchase that stock. I don't want to go into too much detail because this will be like a 20-minute video, so I'm going to try to make it as quick as possible. That way it's easier to digest the information. So right over here on the right, I actually made a cheat sheet, fundamental analysis cheat sheet. You can use this, and it's in order with whatever information you get on Yahoo Finance, and you just have to go step by step, and this will determine if this stock is a fair value or a purchase. Okay, so let's start at number 1, the trailing and forward PE ratio, and it has to be under 20. So we see over here Google stock forward and trailing are both under 20. Now because this is a tech stock, I decided to keep it under 20. Now if it was like a consumer defensive or consumer staple, you want to keep it under 15 for fair value, but because this is a high revenue, high growth, you want to keep it under 20. Alright, and it is a pretty fair value. Next one, which is enterprise value over EBITDA, which stands for earnings before interest, tax, deductions, and amortizations. We want it to be under 10, and we see over here it is 11.64, so a bit on the high side. We're going to give that an X, but we're going to give the trailing and the forward a check mark. This is alright, but it still fails. So moving on to the next step, we're going to look at the profit margin. And we want a profit margin of 20% plus. Now a profit margin is profit from the revenue of the company. Okay, this is its earnings, it's how much profitability it's in, and we see Google is at 23.75%, so it exceeds what we want. So that's a check mark. Next is the operating margin, and we want it to be 15% plus. Now operating margin is basically profit after cost of operating. Okay, operating cost. Profit margin is profits after the cost of sales. Operating margin is cost of wages, raw material, whatnot, like operating costs. And it definitely does way better than 15%, so we're going to give that a check mark. Next, we're going to go on return on assets. Okay, I don't think I have to explain this, but basically return on whatever assets Google has. So think about you owning a property that is an asset. How much money do you get back on asset? Think about that. Okay, so 14%, and we needed 5% and 20%. I put the fire emoji because 20% means it's like it's crazy, it's excelling, and that should catch your eye. But this is doing over 5%, so check mark. Return on equity, our goal is 15%, and this does 26%. Again, check mark. Very good. Now return on equity is basically, it's a little bit more complicated. It's net income over shareholder equity. So net income is profit after taxes, after interest, all that bullshit. It's pretty much all the money you take home in your pocket after the dance is done. And that's over shareholder equity. What is shareholder equity? Shareholder equity is basically all the investors' money, owners' money. That's just a quick form. Google it, but it's a check mark. Okay, checks out. Next, we want to look at quarterly revenue growth. Quarterly revenue growth. We want 20%. This is 6%. Boom, fails. So red flag right there. Quarterly earnings growth is the next one we have to check. And this is negative 26%, not positive 25%, negative. Now these are two red flags we see right here, but don't forget this is quarterly, okay? So in that case, you look at these two, but then you look at the revenue and you go, oh wow, the revenue is pretty big. So what we're gonna do is for the quarterly revenue and quarterly earnings, we're gonna double check, and all you do is you just look it up, and we're gonna move over here. Y charts. This is Alphabet revenue quarterly. So if you look over here for the year of 2022, we'll see where the red flag is. We'll see where the anomaly is. So March 31st, 68.0 billion. Okay, grows to 69.68, and then it falls to 69.09. So there is the difference of why we got where is it, 6% quarterly revenue. Okay, but if we check now, if you really want to see if the company is in trouble for the revenue, you just go look back. You just look back 5 years. So 2018 we see 39, then we go to 36, 38, 40, 46, 41, 38, 46, 55, 61, 70, 80, 60, 79. So as you see, we see the quarterly revenue growing, and we see a miss and drop down here, there, you know, over here. But I don't think this is a red flag. I think because it's just a bear market, it's a little, you know, glitch in the matrix. Next, we're looking at quarterly earnings. Okay, now again, same thing. We see anomaly from June, from the second quarter to the third quarter. Okay, 16 dropping down to 13. Again, we go back over here, we see 9, 8, 6, 9, 7, 10, 6, 11, 15, 17, 18, 20. Boom, it's growing into double digits. It went from single digits to double digits in just 5 years. We're still gonna give it an X, but for long-term basis, it's not a red flag. Now, what I think is the most important thing, you can forget about all that, but the most important thing to look at is the cash and the debt. Okay, the total cash right here, total cash pile, this is important. Okay, because even if they're in debt of 29 billion, what you're trying to see is, can they pay off their debt if they wanted to? And they could pay it off today, tomorrow. They could have paid it off yesterday. So this is the best way to check if the company is healthy. The total cash pile with the total debt. You can also look at the next one, which is debt to equity, and the ratio is right here, 2.52, and we want between 2 and 2.5. Most people will argue they want to keep it around 1, which is fair, but because this is a tech stock, they do have a lot of debt, or they do take on a lot of debt to equity. So we'll say it's a pass. Okay, we'll say it's a pass. I'll pass it. But what I really like about Google is the huge cash pile compared to Apple and Amazon. You'll see their debt is way higher than the cash. So just knowing this, that this is not in any risk of being bankrupt, it, you know, allows me to sleep at night. According with the revenue, high revenue, it does not pose to me as any red flags in the company. Another way to check, and it's not on the list, but you can check, is the operating cash flow. Okay, this is how much money they make after operating costs, and this is levered cash flow, and this is how much money they have left after, again, all the bullshit, but they use this money to invest it back in their growth. So if they have a positive cash flow, positive levered free cash, that means they have enough money to grow if they chose to. Okay, and operating cash flow means they're not, if this was a negative number, that means they're operating at a loss, but because it's a positive number, they're operating at a profit. Now that's a quick way of doing a fundamental analysis on the stock. Another great way is to use this app called Simply Wall Street, and you can see the link in my bio. And you don't even have to pay for this. If you want to pay for it, you get a more extensive outlook on the company, but this is just a quick way to see if the company is healthy or not. You just look at this little circle pie chart over here, and it already tells us this is selling at a great value. So it is below It says actually right here, very undervalued with excellent balance sheet. Now this is why I chose to do Google's balance sheet, because it's an excellent balance sheet and the experts see it themselves. So you can always choose to compare Google's balance sheet with a company that you'd like. I think that's a great idea. But anyways, let's look at the risk factors over here, okay? Are they forecasted to achieve profitability? Pass. Revenue earnings forecast to grow. Like I showed you guys, it's forecast to grow. They just had a weak quarter, so nothing to be scared of. But pass. Is their dividend sustainable? They don't have a dividend. Is their share price liquid and stable? Share price has been stable for the last 3 months. High quality earnings. No insider selling, which is great. And you can see right here, no risk detected for Google. And honestly guys, use Simply Wall Street and use Yahoo. These two tools, great way for you to do analysis, okay? Now for this cheat sheet here, there are 11 settings. You just need to pass 7-Eleven. So just think about the convenience store, 7-Eleven. It needs to pass 7 out of 11. And if it passes 7 out of 11, I think the stock is good to buy. And Google, I think, did pass 7 out of 11 from our checklist over here. But anyways guys, that's a quick option analysis. So I hope you guys enjoyed it. Hope you guys can learn something. Let me know if there's any more questions. Feel free to leave a comment, and maybe I'll do analysis on other popular stocks. But guys, that's pretty much it. And practice this. It's very fun. Once you start enjoying, once you understand the company, Google the terms. Just sit down with all the terms on the balance sheet or the statistics on Yahoo Finance and just go through everything, like market cap, what is it? Google it. What is market cap? What is trailing PE? And really digest it. These are things you need to learn. If you're not good at looking at technical analysis and reading charts, then at least be good at fundamental analysis. Don't just buy a stock. Look at the fundamentals, okay? A stock is not the price. A stock is a company. You are investing in a company. So guys, please do your research. And this is the best easy way to do research on a stock that you're investing. If you can invest in these stocks by looking at the fundamental analysis and the balance sheet is bulletproof, how can you go wrong in a year or 2 or 3 or 4? So I hope that helped guys. Make sure you guys subscribe, like, comment, and we'll see you guys again next time.